Turning 40 often triggers reflection. Am I behind? Should I have more saved? Is it too late to catch up? Here is the reality. Your 40s are not the decade of regret. They are the decade of financial leverage. You likely have peak or near peak earning power, more clarity about priorities, less tolerance for waste, a shorter runway to retirement, which creates urgency. This decade is not about flashy investing. It is about structural strength. In this video, we will break down the major money milestones to accomplish in your 40s, grounded in financial planning principles, not hype. No unrealistic promises, no get rich fast, only practical, evidence-based financial structure. Let's begin. Know your real net worth. Most people track income. Fewer track net worth. Net worth equals total assets minus total liabilities. Assets include cash, retirement accounts, brokerage accounts, home equity, business equity. Liabilities include mortgage balance, auto loans, student loans, credit card balances, personal debt. Why this matters in your 40s? Net worth measures trajectory. Income measures activity. You can earn a high salary and still be financially fragile if debt offsets assets. By 40, you should know your exact asset allocation, your exact debt balances, your monthly burn rate. Clarity removes denial, and denial is expensive. Eliminate high-interest debt. If you still carry high-interest credit card debt in your 40s, this becomes priority number one. Credit card interest often exceeds long-term market returns. Historically, broad U.S. equity markets such as the S&P 500 have returned around 7 to 10% annually over long periods after inflation adjustments, though returns vary year to year. Credit cards commonly charge far more than that. Paying off high-interest debt provides a guaranteed return equal to the interest rate avoided. That is risk-free return. In your 40s, the focus shifts from expansion to efficiency. Interest drag becomes unacceptable. Build a fully funded emergency reserve. In your 20s, a small emergency fund might be enough. In your 40s, responsibilities are larger. Mortgage, children, aging parents, insurance premiums. A reasonable benchmark is 3 to 6 months of essential living expenses. If your income is unstable or you are self-employed, consider more. This is not investment capital, it is stability capital. The purpose is not growth, it is decision protection. Without liquidity, market downturns force bad choices. With liquidity, you maintain control. Be on track for retirement contributions. Financial planners often suggest rough benchmarks. By age 40, many guidelines suggest aiming for roughly 2 to 3 times your annual salary saved for retirement. By age 50, around 5 to 6 times salary. These are not guarantees, they are directional indicators. Your specific needs depend on lifestyle expectations, location, health, longevity assumptions, investment returns. But your 40s are critical because compound growth still has time to work, but less margin for delay. Key actions: maximize employer retirement matches, increase contribution rates when income rises, avoid pausing contributions unnecessarily. Consistency now matters more than speculation. Protect your income. Your income in your 40s may be your most valuable asset. If it disappears, the entire structure weakens. Insurance planning becomes essential. Adequate health coverage, disability insurance, term life insurance if dependents rely on your income. This is not pessimism, it is risk management. Insurance does not create wealth, it prevents collapse. Education funding plan, if applicable. If you have children, your 40s often coincide with rising education costs. Key principle: you can borrow for education, you cannot borrow for retirement. Retirement funding should not be sacrificed entirely for college savings. Balance matters. Evaluate: expected contribution capacity, financial aid eligibility, state-specific education savings vehicles. Avoid emotional overcommitment that compromises long-term stability. Optimize investment allocation. Risk tolerance often shifts in your 40s. You are no longer investing with a 40-year runway, but you still need growth. A portfolio that is too conservative risks inflation erosion. A portfolio that is too aggressive risks drawdown shock. Diversification across asset classes remains foundational. Rebalance periodically. Avoid performance chasing. Your 40s are about disciplined allocation, not dramatic bets. Pay down mortgage strategically. Whether to accelerate mortgage payoff depends on interest rate, tax considerations, and opportunity cost of investing. If your mortgage rate is very low relative to expected long-term investment returns, aggressive prepayment may not be mathematically optimal. However, psychological security has value. The milestone is not mortgage paid off by 45. The milestone is having a deliberate plan, not drifting. Estate basics in place. Estate planning is not only for the wealthy. In your 40s, you should consider a will, guardianship designations for minor children, beneficiary updates on retirement accounts, healthcare directives. Without documentation, state laws decide. Planning reduces legal complexity for your family. Define your retirement vision. Retirement planning is not only about numbers, it's about structure. Questions to answer in your 40s. When do you realistically want financial independence? What annual spending would feel sustainable? Will you relocate? Will you work part-time? The clearer the destination, the more accurate the planning. Without clarity, savings targets lack context. Increase savings rate, not just income. Many people in their 40s earn more than ever and spend more than ever. Lifestyle inflation becomes subtle. Bigger house, more travel, higher recurring expenses. The milestone is not simply earning more, it's expanding the gap between income and spending. That gap is your freedom margin. Reduce financial complexity. By your 40s, accounts multiply. Old 401ks, brokerage platforms, bank accounts, insurance policies. Complexity increases oversight risk. Consolidate where practical. Simplify tracking. Automation reduces error. Clarity reduces stress. Prioritize health as financial strategy. Healthcare costs rise with age. Preventative care is not just medical advice, it's financial strategy. Chronic illness significantly impacts lifetime expenses. Investing in health, exercise, nutrition, preventative screenings supports long-term financial resilience. Plan for aging parents. Many people in their 40s enter the sandwich generation, supporting children and aging parents. Discuss expectations early, clarify boundaries, explore long-term care considerations, avoid crisis-driven decisions. Build non-market assets. Financial wealth is one dimension. Career capital, professional network, skills, reputation. In your 40s, protecting employability matters. Upskilling may not feel urgent, but relevance protects income durability. Reality check. You may feel behind. If you're 42 and feel behind, understand this. Comparison distorts perception. Financial progress is not linear. The productive response is not shame, it's recalibration. Increase savings gradually. Reduce unnecessary expenses. Revisit assumptions. Time still exists, but it is now valuable. Closing. Your 40s define your 60s. The financial structure you build in your 40s determines flexibility in your 60s. This decade is about stability, clarity, protection, and intentional growth. Not speculation, not shortcuts. Major money milestones in your 40s are not about status, they are about resilience. If you accomplish even half of these deliberately, your financial foundation strengthens dramatically. The question is not, am I too late? The better question is, what structural improvements can I implement this year? Because your 40s are not the end of opportunity. They are the intersection of experience and earning power. And that combination is leverage if you use it deliberately.